Good morning. Thank you for joining today. In addition to the usual market update, I'm very happy to welcome our guest speaker, Marius Kähler, who will be taking us through his tips on how to make the most of the tax year end. Tax year end is end of February, end of this month, and he has some exciting and very interesting tips, so stay tuned for Marius and his top trumps. Okay, let's move on to the market update. So January was a strong month for developed markets and a weak month for the rand, which basically meant that global developed markets were the clear winners for the month, as you can see from the chart. Japan was the outright winner, up 6.6%. Great month from the Japanese stock market in in rand terms. So that excludes the yen weakness. Interestingly, the reason that is given for the very strong return from the Japanese market is that Chinese investors, so local Chinese onshore investors, are so exhausted from their stock market, which continues to plummet, that they are moving their investments offshore and they're buying the Japanese ETFs. And you can see there on the chart, the worst performer for the month was China, down 8% in rand terms. China continues to be plagued by its property market, which has collapsed, and it's leading to disinflation within China, and just a lack of overall support from the government, concern about gaming regulations and other regulations. So investor confidence is at all-time lows in China, and that can be seen when the domestic economy, domestic investors are moving their holdings offshore into Japan. And there's definitely no love lost between China and Japan, so that is quite something. Other things that are interesting to note, the other losers for the month, the Fourth Industrial Revolution Fund, down 4%. That's the ETF, and that's a proxy for small caps. So small caps were down in the month of January, as was global property, down 3.4% in rand terms. And that was on the back of interest rates expectations in the US. So we had some very strong data in the US. I'll talk more about that later. And that led the market to price in fewer interest rate cuts in the US for 2024. We went into the start of the year with the Fed expecting 3 cuts this year in 2024 in the US, with the market expecting 7 cuts, and that's now down to below 6 cuts. So the market repricing that easing to slightly fewer cuts, although there's still a dispersion to the Fed is pricing and what the market is pricing. The FANG stocks, once again, clear winners, up 5.6%, second best after China, and they remain the best place to hide in this higher for longer, high interest rates, high inflation environment. Not that inflation isn't falling and interest rates aren't going to fall, but right now they are high. And I'll definitely talk more about small caps later on today when we just compare how small caps have done to large caps and when we think that is going to turn. Looking at the top Sygnia funds for the month of January, over 1 month, a clear winner there, up a beautiful 9%, is the Berkshire Hathaway Fund. And that was driven by its very defensive positioning. It's got a lot of cash on the portfolio, but also US insurers had a very strong month as a whole in the US, and that helped drive Berkshire Hathaway up at 9% for the month. The FANG AI Fund was up 8% in the month, and it's more than the chart before because of some active returns in the fund. The fund was overweight AMD, which had a great month, and that helped the fund do better than the benchmark. Japan, you can see there, up 6% in line with the index. The Fourth Industrial Revolution Equity Fund, which is the unit trust, up a 6%. So as you can see, nearly 10% improvement on the unit trust versus the ETF in the month of January. Because of the focus of that fund on large caps, we have shifted the holdings in that fund to focus on large caps to benefit from our view of the current economic environment. But again, I'll talk more about small caps versus large caps when we get to that section later on. But interesting to see that big benefit to the fund in the month of January. And then in fifth place, the Sygnia listed property index fund, up 4% in rands. That was quite an interesting one because, as I said, global property was down quite significantly as the market repriced interest rate cuts and hikes this year. I think that the South African listed property has more to do with the fact that it is low liquidity and it's much harder to get in and get out. And there was probably some strong buying which kept those prices elevated, or just a lack of trading which kept those prices elevated. But that's just my assumption. Looking over at the 1 year period, clear winner there, up 77% is the FANG fund, an amazing return driven by those magnificent 5 stocks, big 5 FANG stocks, plus Nvidia, and to a smaller extent Tesla, which has not done as well over the last month, but still an amazing return from those stocks. And that has lifted the rest of, well, that pretty much talks to the other top 4 performers in second, third, fourth, and fifth place. The Berkshire Hathaway fund in second place at 31%, but you must remember that half of Berkshire Hathaway's listed investments is made up of Apple, and Apple makes up 22% of the market cap of Berkshire Hathaway. So Berkshire Hathaway, despite it being a value quality fund, is actually right now a tech fund, as far as you can call Apple a tech company as opposed to a consumer company. And those FANG stocks not only lifted up Berkshire Hathaway, but lifted up the US up 27%, S&P 500 also US up 26%. And then in fifth place, Japan doing very, very nicely. Japan has certainly outperformed Europe. It's benefited from being isolated from the Ukraine crisis and from the Middle East crisis. And also, as I said earlier, it's benefiting from some strong Chinese demand for Japanese ETFs. So a lot of interesting things happening in the market over January, and the funds reflecting those returns. But generally some very nice returns, particularly in rands, with the weak rand over the last 12 months and over the last month in particular. And then developed markets continue to be buoyed by FANG stocks. Okay, so moving on to the chart of the month. And January, despite the US S&P 500 reaching new highs, January was certainly all about geopolitical risks. So one of the biggest events was the US and UK launched airstrikes on the Houthi targets in Yemen to stop them attacking ships in the Red Sea. And that has definitely escalated, and ships have been forced around southern Africa instead of going straight through into the Mediterranean. And that's obviously added some significant time, which disrupts supply chains and obviously significant cost. And you can see the charts on the right how shipping costs have spiked from Shanghai to Genoa and Shanghai to Rotterdam. Shanghai to Los Angeles not as impacted by the closure of the canal into the Mediterranean, but overall definitely cause for concern. Our base case is still that this doesn't change our forecast for the year, but it all does depend on how long this escalation lasts in the Middle East. Further to that, we've seen the Israel-Gaza conflict escalate as well. Up till now, Iran has played in the phrase using proxies, but in the month of January, they decided to show that they can intervene if needed. And Tehran launched missiles on Iraq and on Syria and Pakistan. Not only that, but Tehran also seized an oil tanker. And at the same time, we've seen the US being forced to launch airstrikes in Iraq and Syria against more than 85 targets that are linked to Iran's Revolutionary Guard, the IRGC, and its militias, which it backs, in retaliation for the drone strike, which killed US troops. So things definitely heating up, not only in the Middle East, but even broader, Russia and Ukraine. Things are also getting a bit more tense. And we've seen NATO launching exercise Steadfast Defender. Sounds like some sort of Star Wars movie. But that is actually the largest operation since the Cold War. And they expect 90,000 troops to participate from February to May this year, from all 31 allied countries and Sweden. So some big saber rattling happening across Europe right now. And maybe we shouldn't be too surprised at that. I mean, we do have 3 billion people voting across 40 countries this year. And whenever people are voting, well, the politicians need to either make themselves look better or try and take the focus away from what they've been doing poorly. And so we expect some more saber rattling, and makes me think of that 1997 movie, Wag the Dog. And certainly a lot of politics, a lot of elections, and a lot of politicians are going to be doing some interesting things this year. South Africa amongst them. So we'll be watching that quite closely. Now, in terms of the impact of this geopolitical risk on our forecast, as I said, we aren't expecting, we haven't changed our base case forecast. The oil price picked up 8% in the middle of the month, but it has since given that back, and oil's trading back at $78 a barrel today. We think that given the risks, there should be about a $10 risk premium in oil. So oil maybe should be up at $90 a barrel. So we do expect that to move up slightly. But I think the bigger risk is the impact on supply chains and whether those delays can cause not only inflation, but supply chain disruptions, which leads to all sorts of imbalances. So from our own internal matrix, where we forecast the probability of different outcomes, we have increased the high inflation and geopolitical risk outcome by 5%. It's not a big change, but it is certainly something that we're watching, and we will continue to watch and see how this all plays out. But for the moment, no change to our overall forecast. We remain on the bullish camp in the fact that growth will continue and will avoid a US recession this year. Which takes me to the US. And my favorite, Donald Trump, he just adds so much color to our lives, well, at least orange. And Donald Trump's landslide victory in the Iowa caucuses caused DeSantis to pull out of the presidential race. But it wasn't just that. Trump claimed his victory catalyzed the Chinese market crash. So that minus 8% return that I showed to you for China in the month of January, Trump has claimed that. He says, China had a crash yesterday in the stock market. You know why? Because I won Iowa. He's just something else. Trump went on to win the New Hampshire primary, which is putting him well ahead of Nikki Haley, and he's definitely the lead for the Republican nominee. And that in itself, very interestingly, is fueling a speculative frenzy in obscure stocks that are tied to his candidacy. And I'm not sure what those stocks are, maybe self-tan companies, but it is definitely having an impact on those small cap stocks in the US. But what does it mean for the overall economy if Trump wins? Well, we don't know. Trump does talk a big game, but sometimes he implements that game, and so it may be worthwhile listening to what he has to say. Two of his big threats are, one, would impact the Ukraine, because he would freeze all funding to the Ukraine, which may impact the Ukraine's ability to continue the war against Russia, and may be forced to settle for peace, giving up its land. So we'll have to watch that to see. The other big impact is on China. I mean, Trump had the huge tariff wars in his first term, and Biden kept those tariffs in place, and they have worked. The deficit with China has improved, but Trump feels that Biden is getting all the acknowledgement for his work, and so he's planning on increasing those tariffs to more than 60% for a number of industries. And now that would be bad for inflation in the US, as well as bad for demand in China. And so that's a bit of a lose-lose situation. So we'll be keeping our eye on that as well. But that is a risk that we're keeping an eye on. In general, the US is definitely on our soft landing approach. No forecast recession for 2024 for the US. In fact, I mean, really, people are talking about US exceptionalism. People are talking about immaculate disinflation. Things really couldn't be going better for the US right now. Inflation continues to fall. The Fed's preferred inflation measure, which is the core PCE, fell a lot more than expected and has almost reached a 3-year low. So inflation continues to fall. More importantly, shelter inflation, which makes up 44% of core CPI and 18% of the Fed's favorite, the core PCE, that is likely to continue to fall, with the Zillow index indicating that rental inflation could fall below 2% by mid-year. So inflation is falling and is forecast to continue to fall over the next 6 months. Meanwhile, the US remains resilient, particularly the US consumer keeps on spending. I mean, US retail sales reached the highest since July last year. US jobless claims fell to a 16-month low. US fourth quarter GDP did fall to 3.3%, but that was way above expectations, and it was driven by strong consumption. Mortgage rates in the US have also fallen to an 8-month low at 6.6%, which will support the US consumer. Bottom line is that things remain robust in the US, and growth is strong, inflation continues to fall, and it is difficult to understand because why can inflation fall while growth is recovering? I think it all talks back to the COVID disruptions and distortions slowly coming out of the system. And yes, things are going to slow this year, but as it slows, so the Fed can start to cut rates. Now, the biggest thing to worry about is employment. And the forecasters of recession in 2024, they've used employment as the big key to that. And they're saying historically, a recession has taken place whenever the 3-month moving average of unemployment has risen by more than 0.33%. And up to this month, we got really close to that threshold. It looked like we were going to reach it. But the unemployment numbers, unemployment actually dropped in January, and payrolls was incredibly strong, double what was expected. So right now that has been postponed, but that's not to say that employment is not softening. It definitely is. And what we look to here is that companies stop hiring freeze, for example, before they start firing. It's much easier to stop hiring than it is to fire. And we're definitely seeing that in the US. The big number there is the job openings, which continues to fall. But we've also got, so job hiring is back to 2018 levels. And at the same time, weekly hours are back to 2009 levels. That's the chart on the right. There you can see average weekly hours. And that talks to the COVID distortion somewhat, and that we're in a new world. Yes, a lot of people are back to the office, but not everyone. There's a whole new sector of employment, people who are working half days, people working from home, people who are working on demand. And there's a much more flexible economy, which is keeping employment higher than expected, but is also not leading to wage inflation growing as much as has in the past when unemployment is so low. And that's definitely keeping the Fed up at night. Is something they don't understand, is something that they're watching very closely. But it does show that things are moving in the right direction. Employment is still a risk that wage inflation could rise, but for the moment, on the one hand, causing rate hikes, or unemployment could lead to recession, causing rate cuts. But at the moment, we seem to be sitting in a nice Goldilocks period where the companies that are conservative and cautious have stopped hiring, but no one has started firing just yet. So Goldilocks remains in the US, soft landing is on track, and we haven't changed our forecast in this regard. Okay, I promised a segment on US small caps, and here it is. And it is really, really interesting. And it's also very, very tempting. US small caps are looking incredibly attractive. The value is looking very attractive. But bottom line here is I don't think we need to rush. And that's why we have changed the composition of our Fourth Industrial Revolution Unit Trust to focus on market cap weighted companies. So not equally weighted, but market cap weighted, and that has given a high allocation to large companies, and that's working very well for that fund. And we expect it to continue to do so over the next time frame. Okay, so let's look at small caps. Firstly, S&P 500 at all-time highs, as I mentioned. So January saw the S&P 500 reach a new all-time high. Incredible given everything that we're seeing around the world, geopolitical risks, China falling into a slump, inflation falling, but still quite high, interest rates projected to cut, but still very high. This compares to the Russell 2000 index, which is a proxy for small caps. Well, it's the 2000 companies in the US. 2,000 largest companies, but it is capped. They do have a cap to keep it more small cap focused. That remains 20% below its 2021 highs. So a big price differential between what's happened in the large caps, driven by the Magnificent Seven, certainly, and in the small and medium caps, which are still way below their highs. But it's not just price performance, it's also earnings. The earnings haven't kept up as much, but despite that, there's still a large discount. So if you look at the PE relative, small caps tend to, over the very long term, trade at a premium to large caps, because you would expect small caps to have higher growth, they're more nimble, and over the long term, small caps have actually outperformed large caps. But right now, small caps are trading at a discount of 0.9 relative to the large caps. Not only that, but they're trading at the biggest discount in more than a decade. So on a price level, small caps are looking cheap. On a valuation, on an earnings-based level, small caps are looking cheap. The third point is that small caps are obviously US focused. They're not global multinationals, whereas S&P 500 and certainly the Magnificent Seven are global multinationals. I'm sure many of you have Apple phones and YouTube accounts or Google Music or Amazon Kindle accounts. And as the rest of the world growth slows, as we're seeing in emerging markets and Europe, also that impacts the top line revenue for those global multinationals in the S&P 500. So the small caps should be more resilient with the US growing faster than the rest of the world, and it certainly is growing faster than the rest of the world. And the fourth point is that 45% of debt, the Russell 2000 index, is floating. That means that the small caps have been most impacted by the rise in interest rates in the US. This compares to only 9% of the S&P 500 companies being floating rate. Basically, the S&P 500 companies are immune to rate increases because they have fixed their debt. Small cap companies don't have the same facilities with the banks. They're forced to use floating rate, and that's why their earnings are certainly under a lot more pressure right now. And I think that is the big driver. So there's definitely, if you were to look at interest rate movements in the US and compare that to small cap versus large cap, the biggest driver is interest rates. And that takes us to the chart on the right. So if we know that small caps are right now being hurt because they're having to pay a lot more interest than large caps, and we can expect the US to start cutting rates, or when should we switch? I mean, that is the key. Now, history is never, let's say, history doesn't repeat itself, it rhymes, as Mark Twain said. But let's look at what history's done. So if this chart goes back to 1926 and has looked at every time the Fed has started to cut rates, and if you look at the chart on the horizontal axis, it gives months, 1 month, 3 months, 6 months, 12 months. And the left-hand axis gives the percentage outperformance of the small caps versus the large caps. So as you can see, before the interest rate cut, 12 months before an interest rate cut, small caps underperformed by about 4% on average. They continue to underperform 6 months before a rate cut. They continue to underperform 3 months before a rate cut. And they do a slight amount of outperformance 1 month before a rate cut. Then after the rate cut, buy the rumor, sell the fact. They underperform a little bit, 3 months, underperform a little bit. And it's only really 6 and 12 months after a rate cut that we see the earnings being supported by the low interest rates and the market starting to reward those companies for that number. Now, it doesn't mean that it's going to happen anytime right now, but we're sticking with our forecast. One, because we don't know when interest rates are going to start to be cut. The market thought it was March. That's since been pushed back to May. We think that July is more likely. And then if you want to add 6 to 12 months to that, well, you're looking at best case scenario at the end of this year. With so much else forecast risk to worry about, bottom line is we think that it's safer to stay out of the small caps for now. And a similar story for global property. Global property is very geared to high interest rates. There is some cause for concern when looking at commercial real estate and their ability to refinance at these high levels. A lot of their funding is 3 to 5 years, and a lot of that's coming to it's maturing this year and next year. And there's some concern that those companies aren't going to be able to roll that debt, and if they can't, that banks could be under huge pressure. So right now we think that although we can see that the light at the end of the tunnel for small caps, and they're looking incredibly well priced, we still think that it's better to stay with the large caps, better to stay with the US, stay defensive, and that's our positioning. Not to say that if you want to diversify, you can't start nibbling. Definitely the valuation shows that you can start nibbling at US small caps if you have the risk appetite and a long-term time horizon. Okay, let's look at the World Economic Forum 2024. So January was also saw Davos take place. And Davos this year focused on the transformative potential of generative AI with a major talking point, and it certainly displaced crypto as the major focus this year. But given the fact that we have 3 billion people voting, the risks were definitely focused on. And here you have the CEO of YouTube, Neil Mohan, saying, the advent of this generative AI technology will lead to amazing things, but will also be a tool that will be bad in the hands of actors. Basically, it's very easy to create fake news with AI, and there's a concern that with all the elections that are taking place this year, with 3 billion people voting, that there can be some manipulation of those votes through fake news using this amazing tool, this transformative potential of generative AI. So big focus on that at Davos. And the second thing that was focused as a result of that, not just misinformation, but focus on reskilling populations and to what extent AI will disrupt employment, lead to unemployment, and how countries can get ahead of that curve and reskill populations to avoid an increase in the unemployment rate as a result of AI taking jobs. I mentioned before that AI replaced crypto as the headline in Davos, but it didn't mean that crypto had its own headlines. And I spoke about it 3 weeks ago at the last webinar, that we saw the approval of the US spot ETF, and it was launched in January. On the first day of its launch, it was estimated that the Grayscale Trust saw an outflow of $5 billion. And the new ETFs which were launched on the day had an inflows of $3.3 billion. So that showed a net outflow. But JP Morgan estimates that the new ETFs are likely to attract $36 billion of inflows, which would take it way above silver, probably as the second biggest ETF after commodity ETF after gold. And the major cause for that is fee differentials. The Grayscale Trust at 1.5%, 150 basis points compared to BlackRock's 25 basis points. So not necessarily leading to new flows into crypto. It may do over time, but for now, the major flows into these ETFs are likely to be investors looking for cheaper options or safer options to get their crypto exposure. Now, the chart on the right is something that I want to share with you. It's not something that I'm forecasting to any extent. It's just interesting. So the orange line, which is end of 2017, marks the date of the first CBOE Bitcoin future. So it was the first Bitcoin derivative contract. The green line shows the next big product, if you want to call it, and that was the IPO, the initial public offering of the Coinbase company. So people could now not only invest in crypto and crypto derivatives, they could invest in Coinbase as a company, as a proxy for Bitcoin. And then the yellow line on the very right shows what we've just seen, which is the launch of the spot ETFs. Now, the first thing to notice is that after the prior to new product offerings, over the next 3 years, the Bitcoin price certainly went up. The other thing to notice is that after those launches, in the immediate short term, the crypto prices went down, pointing to maybe there's a lot of hype ahead of these launches of products, and then it gives you better entry points ahead of longer term improvements. So I'm not a crypto holder, but I just thought it was a very interesting chart for those of you who are, just to see, the 3 major liquidity events that we've seen from an access perspective on crypto. The other aspect that was focused strongly on at Davos was geopolitical instability, geopolitical risks, which I have already spoken about. It was acknowledged that those might impact oil prices, it might impact supply chains, and companies and countries were urged to adopt agile strategies and foster international cooperation. Basically, please everybody work together and stop fighting. It's a nice thing to ask, but it's unlikely that anyone's going to stop and listen. And the final thing that I want to highlight that was focused on at Davos 24 was renewables. Certainly, very, very important. As I mentioned before, we had COP28, which was a bit of a disaster, but renewables were focused on again at Davos. Here we have Luke Triangle, the General Secretary of the International Trade Union Confederation. That reminds me of Viceroy Newt Gunray from Star Wars. But he's anyway stating that developed countries have to assist in the financing of climate action in developing countries. which points to longer term, even more support for renewables. Developed markets will be doing it, and ideally developed markets will finance developing markets so that overall that demand continues for renewables. Excuse me. So let's look at commodity demand and resources. Certainly some very, very interesting outlooks for 2024. So transition metal commodities continue to have very strong demand, and the consensus is positive on clean energy infrastructure, and that includes copper, cobalt, nickel, lithium, but not only clean energy, but also uranium, which is linked to nuclear power, cleaner than coal. Debatable in terms of how clean it is, but all those clean energy companies or commodities are doing very well, not just because they are sources of fuel, but also because they're needed in infrastructure to support the rollout of new power stations, transmission grids, charging points, or whatever it may be. There's no debate that those commodities are going to continue to see strong demand over the next decade. That said, the Goldman Sachs Commodity Index fell 12% in 2023 and continued to fall in January this year. Now, the big reasons for the fall last year were US oil production. So US oil production reached a new peak, and the US is a net exporter of oil, which is quite something. The other factor was a slowdown in China. Now, I think what's important to point out here, and that takes us to the chart on the right, and the chart on the right talks about or shows Chinese import volumes on commodities. And those import volumes over the last 2 years have continued to grow. So yes, China hasn't grown as fast as expected, and Chinese import volumes haven't been as high as expected, but they still are positive and they still are growing. And with China making up 60% of demand for a number of commodities, and that demand still growing, well, that talks to a lot of support for commodity prices, despite China slowing down. Now, in addition to China, there are bullish signs for broader commodity prices. If you look at iron ore and coal, not just the transition metal commodities, and that is driven by supply side disruptions, supply side closures, low inventories, and continued strong demand in the West, with the US growing faster than expected. And we also see some seasonal strength this time of year in commodity prices. So generally, the forecast for commodity prices is bullish, which is good because rising commodity prices helps the rand. That's a very strong correlation that has happened in the past. Unfortunately, when it comes to South Africa and the JSE and resources, there are two complications. The one is, as I've spoken about significantly in the past, it's infrastructure collapse in South Africa, and that we forecast that to continue. Electricity shortages and railway shortages and port shortages all lead to less exports. And we saw coal exports in South Africa down to a 32-year low. 32-year low in coal exports in South Africa. It's just embarrassing. And that is unlikely to change anytime in the short term. One good data point is that South African mining production shot up 6.8% in November, double the Bloomberg consensus. But that doesn't mean that it's just one data point. There's still a lot of constraints in the short term for South African exports. We hope things will get better. Certainly, all the mines are rolling out their own energy infrastructure, so that will be sorted. But it's getting the coal. It's basically your coal and your iron ore, which are large commodities and require rail to get them to ports and then exporting through the ports, both of which are a problem. The other issue right now for South Africa is something that's unfortunately we're at the mercy of, and that is the opposite of the huge move to renewables, and that is the move away from petrol and diesel vehicles, which have high demand for platinum and palladium, and in fact, the whole PGM basket, which are used in auto catalysts to reduce emissions. And as EVs have beaten expectations in terms of that switch from petrol and diesel vehicles, so the demand for platinum has come in below expectations. And that's led to a glut of platinum in the short term. And as a result, platinum price is down to $900 an ounce, and a number of probably up to 40% of South African platinum producers are loss-making or at least cash flow negative. And we've also seen a number of poor capital allocations by those companies and cost slippage. And so there's a general concern for platinum companies in South Africa, and that could hold back the resource sector to some extent. That is debatable. Those platinum companies are also very, very, very cheap. So some of the value players in South Africa are saying that it's a great time to buy. So it is definitely debatable. But when it comes to commodities, the key is global growth. We do think global growth is going to be stronger than expected, which will support commodity prices. China is unlikely to help, but there could be a bazooka stimulus, which would certainly help in the short term. But resources themselves and the rand aren't likely to get a boost. Once again, we're missing the party because unfortunately, we have this platinum price fall in the short term, and we have our own issues of not being able to export our bulk commodities, and that is very unfortunate. So let's move on to South Africa and the outlook there. Here we have South African President Cyril Ramaphosa, who is seeking a decisive victory in this year's national elections. And that is one of the key risks that we see in 2024 for South Africa, is the elections. Now, it's very hard to forecast a decisive victory when you can't even forecast a date for the elections. It is assumed that's going to be 22nd of May, but it might be the 29th of May. I think it can be pushed out as far out as August. So we'll wait and see when we're going to get a final date, but the penciled number is 22nd of May. Standard Bank's Simon Fremantle expects the ANC's vote to slip from 57.5%, so clear majority in 2019, to 47.5% this year, so a 10% reduction in ANC support, which would require a coalition partner to form the government. He also forecasts DA to come in at about 22.5% and the EFF at 11%. But there's huge forecaster risk around this. I mean, as we've seen in the US, polls can be or Brexit polls can be very, very wrong. So this does remain a big risk. Will the ANC sneak in above 50%? Will it come in at 41%? Who will its coalition partner be? While these risks remain, certainly foreigners are going to stay very cautious, and it's one of the reasons why we remain underweight South African equities and neutral South African bonds. We do think there's some risk. Not only that, but there's risk from the budget. We've got the budget in February. We could see some more slippage in the budget. We don't know what's going to happen with Transnet, so we'll see to what extent and how Transnet, the bailout, is funded. And then we also have to see what's happening with wages in the budget. So we're going to watch and wait to see what happens there. But the bottom line when it comes to South Africa is growth. Because of own goals, we are not growing as fast as the rest of the world. Again, we're not enjoying the party that's happening. In 2023, the world grew 4 times faster than South Africa. Emerging markets grew 6 times faster than South Africa. We've got no booster to growth. Things go up, we don't participate because of our own goals. And that's very much infrastructure driven. Rail, port, energy, water, all of that is shaving off between 1 and 2% of growth from South Africa. And based on IMF 2024 projections, if we could fix that overnight, economic growth could be sitting as high as 4% in South Africa. I mean, that would just be incredible. But right now, we are not there. And the sad thing is it's not because of a lack of funding. Pension funds are eager to invest in infrastructure. Pension funds are eager to try and help the ports and rail and energy. But it's the state's stranglehold on its monopolies. The fact that the government won't allow the private sector and pension funds to help out. That is a problem. For at least Eskom, now you can self-generate power, so that has alleviated some of that. But when it comes to transport, well, we can move on to roads somewhat. We've all seen the huge queues on the roads going to Richards Bay. But we definitely need rail, and that rail remains monopoly. And ports, ports are monopoly. And once again, people are trying to export through through Namibia and trying to export through Mozambique to use other options because we can't use our own ports, and it's tragic, unfortunately. It's tragic. So we remain underweight South African equity for now. So bringing us to positioning overall, we remain bullish. So we remain overweight risk despite the risks. And that's supported by the IMF, who've lifted their 2024 growth outlook to 3.1%. So it's up 0.2% on the back of strong US and China. So that was quite surprising. Yes, we knew US was strong and the US has been upgraded, but China, despite its weakness, has actually been upgraded by the IMF. But risks definitely continue to grow, political risks, geopolitical risks, and the number of elections this year doesn't help. We've definitely got risks around Trump and what that'll do in the US. And the US markets definitely do better when the incumbent stays in power. So if the longer that there's certainty that Biden will stay in, or at least the Democrats will stay in power, well, that's better for US markets. And we've just recently seen that in Taiwan, the ruling party there, the DPP, won its third term, which increases tensions between China and Taiwan. So that's not good for just general risk sentiment in the East. So we'll watch that. And as I've mentioned on South Africa, we remain underweight. Inflation came in below expectations, which is supportive for bonds. But at the same time, we do have the budget coming up, and I think there could be some slippage there, which would be negative for bonds. So we remain neutral with very nice yield. So it does remain a good place. Remain a place to be. We prefer our enhanced income fund. You're getting a 10% yield on the Sygnia Enhanced Income Unit Trust with no duration or bond risk. So that's definitely the safer place to be right now, given all that's going on in South Africa for your SA cash or your income portion. Obviously, your global growth portion, you probably want globally just because of much stronger growth offshore. China remains disappointing, continues to send deflationary signals and export deflation. And that's good for the rest of the world because it keeps inflation low, but it's obviously not good for China. It's stuck in this property slump. They are definitely making noises that things could improve. So China cut its reserve rate requirement by 0.5%. The market was forecasting a 0.25% cut, so that was double expectations. Very, very, very strong signal. There's also talk about a $300 billion stabilization fund, and that we use to buy Chinese equities. And that would exceed the rescue package of July 2015. So if that comes about, Chinese equities could bounce quite strongly. And we've seen over the last week, very strong recovery in Chinese equities on that rumor. Now, if that rumor doesn't come to fruition, then the equities are going to give up all those gains and see new lows. But Xi Jinping is busy meeting with regulators and market participants, investigating what solutions could be put in place. So some potential upside with Chinese equities if that happens. Broadly, overall, our view doesn't change. We expect global economies and developed markets, and particularly the US, to accelerate, to not hit a recession based on easier financial conditions, a pickup in the housing market, stabilization in global manufacturing, and unemployment rate not rising. In the US in particular, we think that the non-FANG stocks, the rest of the US is actually going to see a recovery. The rest of the US is actually down over the last year, but with much stronger than expected growth coming through, we do expect those earnings to push the rest of the bulk of the US market higher. That said, the Magnificent Seven are unlikely to slow down or be a drag on performance. So overall, we think that the US is the place to remain. Now, caveats is valuations, and I've said this before, but if you look at the chart on the right, it's just reinforces that. From the very right-hand side, you can see emerging markets. So this chart shows the country breakdown and the PE where it's currently sitting relative to the range over the last 20 years. And you can see the emerging markets, 11.6, the cheapest PE, cheapest valuation on a price to earnings basis, and sitting around about its long-term median. Europe, similarly, in fact, Europe's sitting below its long-term median. Asia, ex-Japan, sitting on its median. That's why you can't see that the purple square. Japan also sitting on its median. Both of those looking cheap. Then we suddenly jump to the three on the left. And the world has 70% exposure to the US. All country world has 60% exposure to the US. And the US, you can see there at its all-time high valuation relative to the last 20 years. And that's then dragging up the world valuation to close to that high, and a 17 PE, and all country world close to its high on 16 PE. So the US distorting your world indices, whereas Japan, the rest of the developed market, Japan and Europe in particular, the emerging markets, and China is not on this chart, but China is certainly even below its median, long-term median, looking a lot cheaper. But just as small caps are looking cheap, and global property is looking cheap, and developed markets ex-US are looking cheap, and emerging markets are looking cheap, and China is looking cheap, we think that the current trend is going to continue as long as the market is not meeting the Fed's forecast of only 3 rate cuts this year, and as long as interest rates stay high, then your strong incumbents that are defensive that benefit from AI will continue to grow and be defensive despite the valuation differences. Okay, so that's the summary for where we are, pretty much the same as we were, but hopefully a few more insights into how we positioned the funds. And let me now hand over to our tax expert, Marius, who's going to share with you some tips ahead of the February deadline for the tax season. Thank you, Marius.
Awesome. Thanks very much, Kyle. And of course, to our esteemed viewers, hello and welcome to a friendly game of Top Trumps. Now, rest assured that Top Trumps has nothing to do with the Donald in this case, but rather it's a reference to a well-known card game that many people on the call on the let's say richer side of 30 will likely remember. So the idea is you have a deck of cards, each card has its strengths and weaknesses, and with friends you put them up against each other and ultimately find out who has the strongest card. So the setup is as follows. The 2023-2024 tax year is at an end, and 4 alternatives today are competing for your excess savings. The players I introduced to you as follows. A new golf set, a new pair of shoes, a tax-free savings account contribution, or a retirement annuity contribution. Each with their own strengths and weaknesses. So the new golf set has a very high remorse score of 102, which increases after your third triple bogey on the 4th hole. The new shoes come with a budget of whatever you have plus 20%. The TFSA comes with an extremely high family approval rating, which I suspect is in the case of the young stargazers, if you invest in the name of your young stargazers, and the retirement annuity with an incredibly low remorse score, which means it actually adds value to your life as time goes on. But before we see how these 4 players pit up against each other, let's just spend 1 minute on the why of tax-efficient investing in the first place. Tax-efficient investing makes sense in various spheres of life. It makes sense socially, it makes sense economically, it makes sense individually. On the first level, on a societal or social level, South Africans have chronically low savings rates, and this has led government to forcibly become quite creative in the form of creating incentives to direct individuals toward more saving. The ultimate goal here is to maximize positive externalities on the economy, like capital deepening, higher savings rates lead to higher investment rates, and so forth, and also decrease negative externalities on the economy. For example, the huge social cost of underfunded retirement obligations, and the overarching idea is on a societal level, you are in reality actually working with the system if you choose to invest in a tax-efficient way, not against the system. Secondly, on an economic level, there's a rich amount of empirical literature showing that there's a significant trade-off in efficiency when spending is done on public sector level instead of on private sector level. I'm always reminded here of one of my favorite economists, Milton Friedman, who said that nobody spends their money as efficiently as the individual who earned it themselves. If poor quality government spending is something that irks you, tax-efficient investing is at least a partial answer to that problem. If you invest in a tax-efficient way, effectively you put your money back into your own pocket, you are free to maximize utility according to your profile, and you become the steward of your own capital once more. On an individual level, the answer here is that given a choice between, let's say, more money or less money at retirement, I have no idea who would choose less, and tax-efficient investing leads to improved retirement outcomes. That brings us to the semi-final between these four players. And ladies and gentlemen, since we hopefully only have extraordinary investors on this call, I'm sure it's not too much of a spoiler to see which of these players will make it through to the final and which are eliminated by the others. And it's a final showdown between a tax-free savings account contribution and a retirement annuity contribution. But before we see how the finalists compete, let's learn a bit more about the two of them. The retirement annuity is up first, and all this is, it's a specialized investment vehicle designed for South Africans who wish to invest for retirement in an efficient way. It should and can be distinguished from an investment product. The retirement annuity itself is not an investment strategy. It is rather a wrapper. It's a legal vehicle or a metaphorical basket that you put your investment strategy into, and the basket itself or the wrapper itself confers the tax benefits on the investment strategy. It contrasts well with a provident fund that you typically get through your employer. Your provident fund typically is an agreement between you and your employer, where your retirement annuity is an agreement between you and your FSP. This offers you an incredible amount of flexibility in the form of control over your investment strategy, in the form of control over things like your contribution profile, and some fringe benefits like, for example, the 0% wrapper fee that Sygnia offers. So how does it all work? In the normal order of things, you are engaged in your productive contribution to society. You generate an income from that contribution, and you pay income tax on your income. The remainder is then left for you to spend, save, or invest as you see fit. In the world of retirement annuities, the wrapper allows you to deduct up to 27.5% of your taxable income, subject to a limit of 350,000 Rand per year, from your taxable income in the first place, and only pay tax on that as an annuity income after retirement. So, ignoring some technical nuances, the idea is essentially that you get a huge time value of money chunk, sort of a loan from SARS that says, yes, you owe me that money, but you can pay me back way later. And in the meantime, you have then the control over the capital to direct it toward investments, make it more, and only pay tax on the annuity income after retirement. The benefits then is that you own the investment, so you don't need to exit your investment strategy when you change employers, for example. You control your investment strategy to such an extent that on Alchemy, for example, our platform, we allow you to choose between over 800 funds to really sculpt your investment strategy just the way that you like it. You can also control contributions. You can do lump sums with us. You can do debit orders with us, and you can change those without a penalty. So a retirement annuity will never be a sword that hangs over your budget and forces you to contribute in months where you feel that your income is better allocated elsewhere. No penalties for changing your contributions. The overall benefit then is that ultimately over an entire horizon, you pay less tax overall. And this is especially true if we consider that the first 500,000 Rand withdrawal at retirement is also going to be tax-free. Now, before we go on to the tax-free savings account, I do just want to mention I'm aware that the two-part system will likely be on many of your minds. Now, we are in an electioneering year, so we expect some details around two-parts implementation to still change as the various powers that be sort of tug of war over the details. But if you wish to keep an eye on how the legislature evolves and how to think about the two-part system and whether the benefits of flexibility are worth the trade-offs in terms of a worse retirement outcome, I suggest you keep an eye on our channels. I know, for example, our head of institutional business, Eva, is preparing an article for publication later this year. Keep an eye out for that. I think it will be a great read. So let's go on to the tax-free savings account again, the other finalist. This is also just a wrapper. It's just a legal vehicle or a basket that you put an investment strategy into, and the wrapper itself confers the tax benefits on the investment strategy. In this case, the benefits are that your growth in the tax-free savings account is free from income tax, free from dividend withholding tax, and free from capital gains tax. In the TFSA tax-free savings account context, be very aware of your limits as well. Your limits are 36,000 Rand per year in contributions and 500,000 Rand per lifetime in contributions. Any excess contributions over 36,000 Rand per year or 500,000 Rand per lifetime will be taxed at a marginal rate of 40%, so don't over-contribute. Similarly, if you withdraw early, remember that a withdrawal from a TFSA does not replenish your limit. So your lifetime limit of 500,000 Rand does not replenish if you withdraw. The ideal then is to invest early, leave it in there for long, and only withdraw when you're ready to sort of give up that birthright of the TFSA and use the money for something, and you have peace that you'll never use the TFSA again. It's a very flexible vehicle. You can have anything from fixed deposits to unit trusts to ETFs in a TFSA. And possibly my favorite benefit would be that it allows you to go 100% offshore. This, of course, gives you access to our thematic ETFs. We are the biggest provider of global ETFs on the JSE for a reason. We have some really exciting thematic ETFs listed there. If you're like me, for example, and you stress about the evolving demographic situation, especially in developed markets, we have a thematic ETF like SygH that allows you to turn that growth headwind into an opportunity. But the essence is that you can actually go 100% offshore with your tax-free savings account. Similar to the retirement annuity, you can also stop your contributions without a penalty. So this will also never be a sword over your budget that forces you to contribute in months that you prefer not to. And then the overall benefits with all the details sort of considered, I think is best explained by a simulation ran by one of our portfolio managers, Mr. Wessel Brandt, who showed the effects of the tax-free savings account long-term investor, investor A, compared to a similar long-term investor who invests outside of a tax-free savings account, investor B, and then investor C, who is a more short-term investor who buys and sells more actively, realizes capital gains and so forth, and also does that strategy outside of a TFSA. The short of the long of this research is that the TFSA investor outperforms the investor B, the non-TFSA long-term investor, by 23% and the short-term investor by 42% over the entire investment horizon. This is why I like to call the tax-free savings account sort of investments on easy mode. It's an incredibly rewarding journey to make use of this compounding effect over the long term and see your growth from last year compound on the growth from the year before and next year's growth on this year's growth. And really never again will you get such a rewarding entrance into the world of investing as a tax-free savings account. And it lets you benefit from the eighth wonder of the world called compounding. And it's really true, the numbers on your screen. A very humble contribution in the early years can really turn into an extremely compelling number over a long-term investment horizon. Up next then, ladies and gentlemen, is our final. And I'm sure we are all wondering who will win. The answer is, of course, the real winner is the extraordinary investor with both the tax-free savings account and a retirement annuity. The reason for this is that these vehicles are not substitutes. They're rather complements. For example, they have various different strengths. If we look at, for example, the retirement annuity, that can't compete with the tax-free savings account in terms of the offshore allocation. The retirement annuity is limited in terms of Reg 28. The TFSA is not. Similarly, the TFSA can't compete with the retirement annuity in terms of the immediate tax deductibility. Your tax-free savings account contribution is only done after you pay income tax on your income. So it's really important to understand that these aren't substitutes, they're rather complements, and no real holistic overview financial plan is complete without both of these. Before we go to any questions, I do just want to mention a couple of tips that are always relevant in terms of these investments. Always consider suitability. Generally speaking, the younger and richer you are, the more risk you can stomach. If you are very young, very rich, and you invest in an extremely low risk strategy, you might not be capitalizing on your ability to chase returns. Similarly, if you're close to retirement and you're chasing returns with a very aggressive strategy, you are chasing those returns with money that's supposed to be taking care of you in the very near future. So just always remember suitability. Consider the offshore arguments and the benefits, specifically if you are somebody who's more bullish on the offshore investment opportunity set versus the local one. The TFSA allows you to go 100% offshore. The RA is regulated by Regulation 28, so it will limit you up to 45% offshore, 75% equity, and 25% property. Some details like fixed income tax exemption is important to remember. Remember that fixed income is tax exempt up to 23,800 Rand per year anyway. So if you use a tax-free savings account, but you put fixed income instruments in there and your return from those are less than 23,800, you're actually not making full use of the benefits that a TFSA confers. The same confers, and the same argument is true for capital gains tax. So generally speaking, generally remembering suitability, but generally speaking, a tilt more to the aggressive side will make you optimally benefit from the tax-free savings account advantages. Also, remember that your general happiness over time with your TFSA and your RA will be underpinned by your relationship with your FSP. So over an investment horizon, it's overwhelmingly likely that at some point you will get the bad news on your news feed. You will want to know if there's a new war breaking out, what's the effect on my investment? It's important to then be able to log into an efficient, easy system that allows you to keep a handle on your money and your investments. Another case is, for example, if SARS needs something like a contribution certificate from you, systems and admin in terms of your FSP is extremely important. And you need to be able to log into an easy system that's highly efficient and allows you to come right easy with those kind of routine requests. Here, I always say it's best to partner with an FSP that has sort of one foot in the world of investment management, but the other foot in the world of technology. So the established fintechs of the landscape is the ideal here. Finally, and I think perhaps one of my most important points for the day is on fees. We remember that our National Treasury did some research that shows if you can decrease your investment fees from 2.5% to 0.5%, you can actually retire with 60% more money. And fees come in layers. They come in the form of a total investment charge. They come in wrapper fees, which is 0% at Sygnia, admin fees as well, and advice fees. So just always remember to drill down through all the layers of fees and make sure that high fees don't eat up your compound growth before it hits your pocket. That, ladies and gentlemen, is all from my side. I thank you for listening, and let's take some questions and hear from you. So just a point of order, I'll try to take a couple of questions, but I'm also not going to take too much of your face time with our head of investments. So let me just look. I see some long questions. And ladies and gentlemen, always know that after the webinar, I do get a printout of these. If I don't get to your question, then I definitely will get to you on email later. Lundani asks, can you please explain what happens if I don't meet 36,000 Rand limit? Can I make up for it in the following year? The answer to that is no. So you have to make use of your 36,000 Rand limit this year. And if you don't make use of that, you can't over contribute next year. The 36,000 Rand stands per year, and then the 500,000 stands per lifetime. Thank you, anonymous attendee. Yeah, so currently the RA tax-free contribution limit is 350K, which is no longer a lot of money. Is there a lobby to get this adjusted with inflation? I think probably all of us agree on that. We also just function in the regulatory landscape. So we are bound to that. I'm sure all South Africans will be on the side of that lobby if that's on the table. Carl, I see an overwhelming amount of questions for you here. I think I'm going to let our viewers engage with you.
Marius, thank you so much. That was fascinating. Really appreciate you joining us today.
Awesome. Thank you.
Okay, thanks, Marius. Very interesting. Hope you guys all wrote down your tax tips for the year. Definitely some interesting opportunities to max out your RA before the end of the month. You know me, I'll be maxing out Skeleton Balance 70. That's my favorite RA product. On the TFSA side, some people might want to go defensive, enhance income, 10% cash returns, no risk, or you might want to go long term and invest in one of our global ETFs. Sig ESG is probably my favorite, low cost exposure to the entire developed world with a very slight ESG overlay on that, but low tracking error. So effectively, like an MSCI World, in fact, it tracks the S&P 1200 global index. So Sig ESG, a nice one for some long-term TFSA savings if you're looking for global equity. Okay, Mike asks, is it worth switching a substantial investment in Skeleton Balance 60 to Skeleton Balance 70? So Mike, that all depends on your time frame and your risk appetite. If your time frame is long term, so we're talking 7+ years, then it boils down to, then both are applicable. And then it boils down to your risk appetite. If you want to take on slightly more equity, then Skeleton Balance 70 is there for you. Over the long term, equities should outperform bonds, and so that fund over the long term should do better. I always do suggest when doing any switch that you do it in tranches so that you aren't adversely impacted by volatility, short-term volatility, and just to smooth that transition from one into the other. But again, it boils down to your risk appetite. 70 has 10% more equity on average, and most of that's global equity, and what to do with that. Paul says, are you guys pro-China in your views, even though a lot of people are coming out and saying it's uninvestable? Paul, I don't think China is uninvestable, but as you know, we don't have China, or we underweight China in many of our funds because we are waiting for some sort of stimulus to happen. Right now, they're stuck in a deflationary cycle because of their property bubble, which burst, and they're not doing enough to convince local investors to support local investment confidence so that people invest. And there's a huge divergence now between savings. China is a very, very big savings culture, and investments, and that's leading to the surplus of savings which are not being reinvested in China. So we need the government to come to the party. When they do, then China could have a very nice bounce. But until the government agrees with this view, we're staying on the defensive side, staying underweight China and underweight EM as a result. Christopher says the oil price is coming off even though geopolitical tensions remain high. Presumably this is because of so much new supply coming on stream. Yes, certainly, Christopher. It was excess supply in the US that has kept the price down. But also in general, although OPEC likes to claim they can cut supply, it's much harder to cut supply than talk about. It's much harder to implement supply cuts than it is to actually talk about it. So that is part of it. But we will see what happens. I definitely think that oil price could go up by $10 to at least include the risk premium that should be there. So we're looking at $90 as a fair price right now compared to the spot price of 80. Clive says the fourth industrial ETF has performed poorly. You're spot on, Clive. If you had to graph the fourth IR ETF against the Russell 2000, which is the US small caps, they move tick for tick. Basically, what's happened, over the long term, the fourth IR has actually outperformed. So fourth IR has outperformed the Russell 2000, but over the last few years, it's been tick on tick, which just shows that it's a small cap story. Small caps will recover, but it's probably 12 months out before we see some recovery there. Yeah, if you want to diversify into the large caps, that is also useful. But on the one hand, you want to make sure that if it's discretionary money, that you make maximum use of any CGT gains or losses that you have. And once again, everything in tranches. You don't want to be hurt by short-term volatility. Rian asks when the soft suspension on the 4th RR unit trust is going to be lifted. Rian, unfortunately, not anytime soon. As you would have seen, communications went out that we've added to that the FANG unit trust has also been soft closed, as well as the healthcare unit trust. And we are unfortunately at our SARB limit. We don't want to breach that limit because then flows get shut down across our whole ManCo. And so we are soft closing to avoid that. And we are trying our best to attract domestic assets, which will then give us more capacity for global assets. But so far we haven't had any change to that outlook. So for the moment, those are closed. The good news is that it's only closed for discretionary investment. It's not closed for RAs and LAs. And you can get exposure for discretionary investments through the ETFs. So instead of the 4th RR unit trust, you buy the 4th RR ETF. FANG unit trust, FANG ETF, healthcare unit trust, you buy the healthcare ETF. So you can still get exposure just in the ETF. EJ asks a very good question. He says, how will Sygnia change the 4th Industrial Revolution ETF compared to the 4th Industrial Revolution unit trust? So you would have seen, or I've mentioned, or if you saw the December fact sheet, that the 4th RR unit trust looks more like the NASDAQ. So we aren't equally weighting that. It's got a market cap exposure, whereas the 4th RR ETF is still following the Kensho index, which is small cap exposure. So we have changed the unit trust because it's an actively managed unit trust. The ETF is passive and tracks Kensho, so we can't change that. That is up to Kensho. We have engaged Kensho. Kensho do not want to change the way that they create the index. So we are considering changing that index, but that will require a ballot, and that will require then all your investors to approve that ballot. So although we would like to change the ETF to also benefit from the current economic environment, it all depends on getting approval to the ballot and getting the ballot approved. But for the next 6 months, at least, no change to the ETF. And who knows, in 6 months, we might want to invest in small caps, in which case the unit trust might look like the ETF again. So we'll see. But right now, at least the unit trust, we have the flexibility to make those changes. The ETF, we don't have that flexibility. Question on commodity prices and that impact on the divvy fund. Correct, the divvy fund is still overweight resources, and that is one of the reasons that the divvy fund continues to underperform. The resources are producing strong cash flows at current prices in general, and that keeps their dividends high and their PE is low, so they are offering value. But a stronger recovery in those resource companies, I think, is tied to export volumes improving. So if we're watching Transnet, and watching port and rail volumes to see when that changes, and for a catalyst to unlock that value. Definitely some value there, but there might be a value trap for the short term in the divvy fund. Serena asks, skeleton balance 60 and 70, are they affected by asset swap challenges? No. So although we've had to soft close our global equity unit trusts, there's no closure required to 60 and 70 funds because they're Reg 28 funds. All the skeleton balance range are Regulation 28 compliant, which means that they are capped at 45% offshore, and as a result, they aren't constrained in any other way, besides being constrained by Regulation 28, which limits that to 45%. For investors, again, a small reminder for investors who are in retirement annuities, and they want more than a 45% offshore exposure, you can invest in the transnational equity unit trust. That fund is JSE listed companies, so you can take up to 75% in a Reg 28 fund, but that's tilted to only invest in companies with primarily offshore revenue, and the offshore revenue currently is about 95% in that fund. So that's a nice way to get more offshore exposure within a retirement annuity, given that 45% capped to global. Sean says EV demand has collapsed, and how does that impact the outlook? So, Sean, that's definitely part of the debate. So the asset managers who are overweight platinum stocks, they say it's because A, EV demand has peaked in the short term, and that diesel and petrol cars are going to catch up. They also say that EV demand, in particular, pure EV has overshot its mark, and we are going to see more market share being won by hydrogen fuel cells, so electric vehicles that are run by hydrogen, not just pure EVs are driven by battery alone, and those hydrogen fuel cells require platinum as well. So there's definitely some support for a longer term bull platinum story if you believe in that story, if you believe that EV demand has peaked in the short term, and if you think that fuel cells have a place, certainly in public transport, in trucks and larger vehicles. I think they do. So that is part of the bull camp. Right now, the market's not pricing any of that. So you could say that the platinum spot price is pricing in a continuation of the EV trend. But until we see that trend change, the market's unlikely to change. But certainly, you could say that the current spot price is overdone if you think that EV market share gains are going to slow. Sean asks as well, if you're a South African resident, is it prudent to have EM exposure, given that South Africa is an emerging market? It's a very, very good point, Sean. It depends on a number of things. I think if growth in emerging markets looks exciting and returns are exciting, well, then you certainly want a portion of it. But right now, with our outlook on EMs and China in particular, having a lower expected return than DMs, we think that there's no need to take on extra EM risk right now. Wayne asks a great question. Wayne says, is there a risk of sovereign bond default with the exodus of capital out of SA? Life annuities priced against bonds, will they be affected by that, or they hedged accordingly? That's a great question. So we actually had I sit on the Actuarial Society of South Africa's investment committee, and we had a long debate about that yesterday. And I think what's important, although it's very unlikely that South Africa is going to default on its bonds, very, very unlikely. And unfortunately, a lot of bad things can happen before you get to default. The rand can weaken hugely. You can get hyperinflation, and you can be stuck in a downward debt spiral. So there are a lot more things to worry about than a default. We're not worried about a default, but there are certainly other risks that you can worry about, like the rand continuing to weaken, like growth continuing to fall, and basically being stuck in a revenue trap where we can't afford to pay our interest because we have so much debt, even though we don't default and we can just print more money. Literally, you can't default, but other things can happen. So yes, they are concerned about those secondary impacts that happen before default. Specifically on life annuities, there's two things. One, there is a large amount of capital that has to be held against that in case market moves against those life companies. But in addition, most of those companies do hedge their annuities with bond holdings. So with sufficient asset liability matching, even if bond yields had to spike a lot from current levels, those companies are well hedged. It just means, right now, life annuities look incredibly attractive. You can get, with bonds at 10%, you can get a really lock in a 10% return for 30 years. I mean, that's just wonderful. That gives you such a great pension. But what happens if those bond yields do go to 15%? The rand has weakened over the last 20 years at 5% a year. Over the last 7 years, it's weakened at 7% a year. So will the rand mean revert and reverse that difference at 7% over the last 5 compared to 5%? Will it accelerate? There's so many unknowns. But even if it reverts back to 5%, if you can buy developed market bonds at 4% and you get rand weakness at 5%, you're getting a 9% yield in DM bonds versus a 10% locally. Well, maybe you want to earn a little bit less and be a bit more in your living annuity, have a bit more flexibility. So there's a lot more about your question than I can answer. But certainly a default, South African sovereign default is not expected at all. Okay, so then there's some questions that Morris has answered and some questions Morris hasn't, but I'm sure he will reply to those by email. Kubus asked a good question, and Kubus, I don't know the answer to this. So we are working on it, but I can't tell you if it's going to be part of our new platform's functionality or if it's part of our new functions platform 2.0. But he says currently, if you buy ETFs on our platform, you have to manually reinvest the dividends. They don't get automatically reinvested. Are you looking at that? Yes, we definitely are looking at that. Yes, currently our platform can't. I'm not sure if the new platform can, or if it'll come out in the first release of the new platform or the second release of the new platform. But it is something we are looking at. So I apologize for the manual intervention that's required on those ETFs at present. Sean says, Sean, you should give you a guest panel spot. Another question from me. The government has proven untrustworthy, and so you're not going to invest in an RA. That's fair, but just remember that up to your 350,000 Rand limit, basically you get half of the money that you invest into an RA back from SARS. So on the one hand, you get nothing. On the other hand, you get half back, and that half is at risk along with the other half that you invest, but you really are only putting half of your capital at risk. So even if they underperform by 50%, you kind of break even. So I still think it's worth the tax benefit. Janine asks, and again, a wonderful question. Does Sygnia offer an offshore endowment wrapper? Not yet, Janine. We definitely want to. We did have our offshore UCITS dollar-denominated funds for a while, but they proved too expensive to run. And we have found a cheaper option for that to do with as much regulatory safety. But we're only going to launch those funds once, again, our new platform can handle dollar offshore endowment wrappers so that you can buy seamlessly, invest in that through our platform. Now, once again, I think that's on platform 2.0 release, not platform 1.0 release. So that's not in the immediate future, but it's definitely something that we're looking at in the next 12 months, hopefully. So keep an eye out on that. Carl, I stand to be corrected. I'm not the tax expert like Marius is, but you say if you invest 100,000 in a TFSA and it grows to 200,000 and you withdraw the 200,000, does that whole amount come out of your 500,000 limit? Yeah. No, I'm sorry. I'd be guessing. So I'm going to leave Marius to answer that question as well. Des asked for an update on the Sygnia OSE funds. Des, we are definitely going to be, I'm going to include that in either the next webinar or the following webinar. I'll give you an update on that. So keep tuning in, and I'll give you an update on that and a more detailed update on Fourth Industrial Revolution Fund, both unit trust and ETF. Some more questions for Marius. Calvin asks a question I get almost daily. Sygnia's stance increasing the offshore allocation of funds to 45%. So currently Skeleton 70 is sitting at 40% offshore. Calvin is saying, would we increase to 45? Calvin, would probably increase, well, put it this way, if the Rand strengthens, we'll probably increase that to 43. We're unlikely to go to 45 just because then you're forced to rebalance regularly, and we don't like having to be forced to rebalance and do cash flows which have expenses. But we could increase from 40 to 43. It's not a big move. We think we're comfortably close enough to that limit from an overall perspective. I don't think 3% is going to move the needle much. But if the Rand does strengthen, we certainly will go to the maximum that we feel comfortable, which is probably 43. Leon asked for performance on the Health Innovation Fund. Leon, so the Health Innovation Fund does a number of things. About 5 to 10% of it is invested in innovation stocks, and about 90% of it is invested in passive healthcare ETFs, or we track the ETFs and by buying the stocks. And the problem with that fund is not that it's underperforming, that it's healthcare, well, it is underperforming, but it's not through any decisions, is because healthcare has done very poorly over the last year. So if you look at the performance of sectors, and maybe I should delve into this in another webinar, and it's a good point. Over the last year, global bonds have done very poorly. As you know, yields have gone from 2% in the US to 4%, and returns, in fact, the last 3 years have been negative on developed market bonds. And that's why for the first time, we've actually bought some developed market bonds, and we're sitting at neutral. Now, you have a number of equity sectors that are seen as proxies for those for the developed market bonds, and those are your shut stocks. It's your staples, your healthcare, your utilities, and your telecoms. Those are all seen as defensive alternatives to buying bonds. So you can either buy bonds, which is your ultimate safe haven, or you can buy utilities, healthcare, staples, and telecoms, which are very defensive. People generally still have to spend on healthcare when things slow down, still have to spend on utilities when things slow down. And because those are seen as proxies, they haven't done as well as other sectors. So they've been held back by the fact that bond prices have gone down and bond yields have gone up. So now that we've reached the inflection point of bonds being a fair value, or we think that headwind to bonds to healthcare stocks has gone away. It may, like small cap stocks, it may take a while. We have to wait for interest rates to be cut before we see healthcare stocks rebound strongly. But we think that healthcare is still a great structural investment, that over the long term, you see aging populations, you see increasing wealth of populations, both of which leads to double the spend on healthcare as opposed to the spend on broad GDP, which even in a slowing world means that sector is going to outperform. So right now we've seen a valuation derating because of interest rates being high. Earnings are still growing very well. Things are still exciting in that sector, and we think that healthcare as a whole will do well. And the innovation sector is also going to do well. Yes, venture capital has been held back. That's impacted OAC. It's impacted some of the venture capital holdings in the fund. But again, interest rates peaks, healthcare sector remains strong, and we do think that will come right with time. But as I said, we'll do a short segment on OSE, which is mostly healthcare focused in the next webinar or two. Question from Marius. Mervyn asks a question on the 4th hour ETF and trust. Mervyn, I think if you have a look at the fact sheets, you can see exactly how they are. The one is closer to the Russell 2000 US small caps. The other one's closer to the NASDAQ 100 in terms of that exposure. And yeah, the top 10 holdings on both those fact sheets. So have a look if you want to see exactly how those compare to each other. Doreen says, please repeat the recommended global ETF to invest. So my favorite global ETF is SIG ESG. And that is, we used to have an ETF called the Sygnia Sustainable Economies ETF. That was SIG SE, and that was closed down. So it's not that fund. And there was some confusion. SIG ESG is the S&P 1200 Global ESG Index, which is the S&P's version of the MSCI World. But it's much cheaper, so we recommend that you go that. It's cheaper than the MSCI ETF, and it does have a very small ESG overlay, which reduces exposure to coal and other high emission companies. So you get the benefit of a globally diversified portfolio with a small ESG tilt overlay as well at a very low price. So that's the most diversified global ETF that we have. So you can either choose SIG World or SIG ESG as our global ETFs, global equity ETFs, but SIG ESG is the cheaper option. No update on timing for our new platform. Vanessa, there's a lot more questions to designing your own regulation compliant fund. So I can't give you all. I mean, Regulation 28 is huge. But your big ones are you can't have more than 45% offshore, and you can't have more than 75% in equity. Beyond that, there's a whole lot of other regulations, so it is quite difficult to do that. However, if you invest in Reg 28 compliant building blocks, you can put together something, but it is probably something you need some financial advice on to make sure you meet all the Reg 28 compliance requirements. Yeah, see, it's 12:30. We're nearly out of time. A few more questions. Mervyn, I'm not aware of a Sygnia Atrix hedge fund. We've got the Sygnia Atrix Health and a health fund, health ETF, but not a hedge ETF. Serena, the Skeleton Balance 60 fund has about 60% equity overall, and the Skeleton Balance 70 fund has about 70% overall. And that's then split between domestic and foreign. Peter says, what's our house view on the rand? Crystal ball. Peter, what I can tell you is that Bloomberg consensus estimates for the rand is stronger at 18.25 by the end of the year. The South African bank economists as a whole, they forecast roughly 17.80. So they're a bit more bullish. So the local banks are a bit more bullish than the Bloomberg global consensus. Commodity prices should support the rand. It all depends on to what extent we see it happening in the budget, to what extent how elections play out. So if you think that the budget's going to be a best case scenario and elections are best case scenario, then we could easily, on the back of interest rate cuts in the US and commodity pricing is recovering, we could be back down to 17.50. But there are a lot of risks which could see us at 19 or 20 rand to the dollar. So very hard to say, but yeah, consensus is for the rand to strengthen from these levels. Anonymous, we do offer Sygnia for Life, which, yes, you're right, is a combination of a guaranteed annuity and a living annuity. Spot on. Pleasure. And Mervyn says that his questions on the Sygnia Atrix hedge fund came out of GPT-4. So no more said. If you're looking for hallucination, AI is the place to be. It is fantastic, but you've got to double, triple, and quadruple check what it says. So it's just a starting point for now. It's going to get better, but definitely it can't be trusted at this point in time. So that's all the questions. The rest of the questions I'll leave for Marius. Thank you, everybody, for joining. It was a pleasure to talk to you. Thank you, Marius, for sharing your tips. And I will see you all in March. Have a fantastic February. Don't forget to make your investments into RAs and TFSAs before the tax year end. I certainly will be topping up Skeleton Balance 70. Take care.